Welcome to Magnifi Plus, where we help you invest with intelligence, which means with Magnifi, you can now do more than just trade stocks. You can search, discover, and invest in the ideas and values that are most important to you using our revolutionary machine learning software. I'm Nicole Lapin, former CNBC, CNN, and Bloomberg anchor, and your host for today. Today's guest is Darren Rovell, a senior executive producer at the Action Network, former ESPN and CNBC sports business reporter, and my former colleague and very good friend. Darren is, of course, a forward thinker, mover, shaker with anything and everything to do with sports business. Darren, thanks so much for being here.
Good to see you.
Great to see you. So you have recognized super early on that the gaming side of sports business, be it fantasy, legalized gaming, yada, yada, was going to be a driving force for growth. And it was, but investors who participated in the space lost so much money in 2022. So what happened here as publicly traded sports gaming companies did so poorly, despite the fact that fantasy sports and gaming are still growing faster than the economy?
Well, just obviously competition was a big thing. You have in New Jersey, you have 23 different sports books on your phone that you can bet with. So, and are they that different? The average person downloads 1.3 sports books. So the idea would be, okay, if we do better promotions or we do better odds, the gambler is going to come to me. It's not necessarily true, and that didn't bear out. And that's one of the reasons why things didn't work out, and it came at a cost. The consumer acquisition cost of people, of gamblers, is a ton. And so what happened was you're offering free deposits, you're offering free bets, you're offering all these things to get to the consumer. At the end of the day, that CAC number, that consumer acquisition cost, is just enormous. And then often, because a lot of things are the same, sometimes you can't keep people as you can in other industries. Loyalty in sports betting really hasn't borne out. And that's one of the issues of what happened in 2022.
Isn't that in general with the sports business? Sports folks are fickle.
Well, I guess in the era of free agency, which has happened for the last 25 years, you kind of have to, as a fan, be willing to accept that your star is going to leave at the cost of money. And, so but it's interesting. It just goes to show you that in any market, it is never just one factor. It is never just two factors. It's many factors. Like, I always say when people are betting themselves, they convince themselves, especially novice bettors, casual bettors, convince themselves that there's one factor that's going to change, and that's why they're going to bet it this way. If you don't consider everything, if you don't consider on the other side how much they're paying for those free bets and how much they're paying to get you, and it's not actually working as much as they think it is, that's an issue.
So what are the opportunities you're seeing right now? If there's so many different factors, what's rising to the top?
Yeah, I mean, I always would go to, obviously, the Action Network, the guys that I work for, the idea where we're treating it like CNBC, like we're treating it like Bloomberg, where, essentially, more information about teams than you do companies. Companies are required to report 4 times a year, and a lot of times they move every day on no news. Teams, we know who's injured, we know who's not playing, they have to declare things every day, and we can move on that information. So if you're right 55% of the time, you can be a successful sports bettor. And so in a way, having been at CNBC, having seen the market dynamics, and then going onto the betting side, you could argue, although betting is a zero-sum game, right? So if you lose, you definitely lose. And with stock, you don't have to lose it all and you won't lose it all. You could argue that sports betting gives you a lot more information and makes you a lot more comfortable about what business decisions you're about to make. So I think companies that are good at digesting data, fans will buy that data and will buy that if you think that you can make them a better bettor.
So true. So you mentioned 23 choices. Who do you think will be the one or two fantasy gaming long-term winners here?
Well, it's really interesting. I mean, I would have said definitely DraftKings and FanDuel. And the reason why I would have said that, like, say, 2021, is because I would have said, well, their consumer acquisition cost is just so much less because 80% of fantasy, and those guys were the leaders in fantasy, 80% of fantasy bettors became real bettors. So they don't have the same acquisition cost. They feel more comfortable with the brand. That being said, again, I think that the platforms are not that different. So if MGM comes in first to your market, you start using MGM, and FanDuel or DraftKings comes in 3 days later. I don't know, again, that 1.3 downloads of apps. I don't know if you're going to get there. So who's going to be the winner? The winner is going to be, and this might be just really simplifying the whole thing, those books that can be profitable and retain their customers. And how are they going to do that?
That's my question.
Fanatics should be an interesting play. They're going to come into the market in the next couple months. Thinking the idea of, you have collectibles and you have merchandise and perhaps memorabilia, perhaps you would like to win some of that. And if they can take real money, and you're looking at the cost of the memorabilia and the merchandise at the retail price, they look at it at the gross price. You think you want $100 jersey, they say you want a $50 jersey. There's some good arbitrage going on there. So that's an interesting case. What I will tell you is there won't be 23. There's going to be a lot of mergers. There's going to be a lot of guys that will go by the wayside. It's not. It is real sexy, but it is real competitive. It's like the canned cocktail business.
Tell me more about the canned cocktail business. It's one of your favorite businesses. I like this company called Kickstand. What about you?
So I decided to launch a canned cocktail. It's the only canned cocktail whose chief differentiator is spice, is called Kickstand. The business learnings because every time we're in a market, I go into the market and I see it. It is wild. It is wild to see some of the business learnings. So I won't fail because my liquid isn't good enough. I will fail because there's so much garbage that's taking up space in the store. It's interesting because the beer industry, they owned the can forever. And now the spirit industry is starting to own the can. And you think about convenience stores and you think about, it just used to be beer, and now canned cocktails are coming in. And every day there's 20 or 30 canned cocktails coming into the marketplace. And the whole idea of how you win when each state has different rules, and you can be in supermarkets in some places. Sometimes it depends on the ABV, all this. It's a very interesting business. And obviously with the way that canned cocktails are growing in this country, it's moving at a rapid rate.
Well, owning the can is so great for, of course, the sports business. Let's double click a little bit more on what you are seeing as far as capital appreciation and growth there. Sports franchises, ownership in teams. It's been such a tremendous asset and an investment class in capital appreciation. What was it a couple of weeks ago? What was the Phoenix Suns?
Phoenix Suns over $4 billion. Yeah. And I remember reporting from the news desk at CNBC in 2010 that the Golden State Warriors had sold for $450 million, which was a record at the time. Larry Ellison lost it to Peter Guber and Joe Lacob over $50 million, which is hard to believe that the seventh richest man in the world let go of what became the Warriors with over $50 million. But that is the case. And we were saying how it was the highest. Then the Bucks were bought for $550 million, and we're like, when does it stop? When does it stop? And then Steve Ballmer bought the Clippers for $2 billion. And then all of a sudden we're in $4 billion range for the Phoenix Suns, which is not a top 15 franchise. So you're thinking about, on the Warriors alone, factoring for inflation, the Warriors have 10x'd in 12 years. That is and I wouldn't have said that. I would have said that there would be, and also in the NFL, like I would have said, because of safety, because of issues with concussions and having to pay players and putting them into emergency funds, that I would not invest in the NFL. I don't right now. I think the NHL is the best place to invest. It's still relatively low, and I think the NHL and hockey works well with the speed of a child's brain. So my kids like hockey and have gravitated to it because they can't. Their lives can't sit at a baseball game. They can't.
It's too long. It's just too long.
Too
There's
long,
not enough action.
It's too slow. There's not enough action.
No blood.
Hockey's 20 minutes break, 20 minutes break, 20 minutes break. They got it. But it is really interesting. And then obviously over the last couple of years, as I've covered a lot and I've invested a lot in memorabilia, the COVID curve of how high sports cards and memorabilia went, and now kind of coming close to bottoming out. That's been really interesting to see what was invested in, what is sticking, and what is falling.
Well, how have these Wall Street guys been as owners? Stevie Cohen, David Tepper, Josh Harris. These are scarce assets, and when they do trade, for lack of a better word, a bunch of Wall Street nerds want to get in on it. How have they been though as owners?
It's interesting because Tepper and Harris are in the same bucket. They are basically introverts who just want to own a sports team and don't care that you know them and don't want to be seen. I mean, Blitzer's different. David Blitzer's different, who is his partner on these things on the 76ers and the Devils. But it's interesting how a lot of these guys, it's hard to be an introvert when you're an owner of a sports team. Cohen wants to be out there, be the big spender. So they do it for different reasons. I do see when Josh Harris and Blitzer bought the 76ers for $280 million, that was out of the book of Apollo. It was relative to the marketplace and the 76ers brand, a distressed asset. That was straight out of his book. I still don't know to this day, because I don't have long conversations with Josh. I still don't know to this day, whether it was a heartless, soulless asset or he really wanted to do it. He's not coming to a ton of games. So like there are different groups of owners. There's guys that want to be involved in everything. There's guys that buy the team because they're billionaires and you haven't heard of them and they want to be heard of. But then Steve Cohen is obviously trying to be the modern day George Steinbrenner.
But I mean, think about the price that the Sixers traded for, in the $400 million range. That was a lot. Where do you think these are going to go? I mean, if we're talking about the Suns for $4 billion and then, NFL teams more than that, where is it going to stop?
It depends on, so attendance means less and less, and rights fees mean more and more. So if you're looking into a sports team, you have to figure out where is the next iteration of rights going. And we've started to see it. I would have told you 5 years ago that ESPN would not be broadcasting right now, the NFL. It would be Apple, Hulu, Amazon. And now we're finally getting into Amazon, who pays the rights, and the price that they pay, they find in their proverbial couch cushions. When you look at Apple and Amazon and the cash flow relative to Disney, ESPN, it's obviously much greater. And if I'm an owner, I would salivate and say, hopefully it's going that way, because rights fees have continued to go up. And, you just have to look at Google and YouTube buying the Sunday night, the Sunday DirecTV package, Sunday football. That's incredible. So I think if you believe that rights fees are going to continue to go up, and maybe it will even be with betting, what happens if Amazon uses its one-click technology to allow you to one-click bet things, then it could be there. Betting has certainly made it more interesting, make people stay in it longer, watch it longer, make it stickier. And so, I think that the rights fees are the key to whether you believe they'll continue to go up and up.
Do you think that the YouTube NFL Sunday ticket was a good investment?
I do. I'm still very weirded out over 15 years of this going on, of the NFL Red Zone. I think that so many people watch the Red Zone that I'm surprised that the partners, CBS and Fox, don't object more, or there's something going on behind the scenes, right? Like, so the idea that you're watching every touchdown, yes, there are fantasy people who want to watch a whole game if they have a key player, or you want to watch a whole game if you're a Jets fan. But the product that is the Red Zone is continually the best product. And if you're a Verizon, if you have a Verizon sports package, it's for free. And I watch it at the cost of the cannibalization of full games. So the Sunday ticket where you can watch any game is nice, but I still think the best thing that the NFL puts out, to the detriment of their partners who pay more than $1 billion a year, is the Red Zone.
So we talked about YouTube acquiring the rights for Sunday Ticket, Amazon, NFL's Thursday Night Football. What are some of the opportunities for investing in this clearly growing business that normal investors could take advantage of?
Yeah, I mean, listen, I think the closest thing, and why we saw in COVID so many people getting into sports memorabilia, is the access to that marketplace, right? Like eBay auctions. I mean, anyone can do it. What's interesting is how that investing involved, much like betting. You invest in a player, you watch that player that night, and you hope that what that player did raises the value of the card. Of course, I think a lot of young people also notice that it cannot be just one sole factor, right? It has to be the whole macro environment. Like, this is an interesting example. So Luka Doncic, who plays on the Dallas Mavericks, his card, his rookie card, his base card, Prism card, was $2,000, and there were 10,000 of them that were graded a PSA 10, which is the highest gem mint condition. And I always said, well, there's too many of them. Analyzing some of these markets, like what makes it move, I thought it was based on, oh, there's too many of them, I'm not comfortable. But what I learned was I was actually uncomfortable with the age of the people buying them. So the age of the people buying this card was somewhere in the 16 to 25 range. And what does that mean? It means that when the tough get going, right, when the market gets tougher, they don't have the wherewithal to hang. They could hang as a group like a cartel and not lower the price, and it will continue to stay up. But those cards and modern basketball cards that these 16 to 25-year-olds over-indexed in fell faster because they don't have the backup money to hold on. And so, like, learning, even though I've known of up and down markets, learning and trying to figure out the complexity of these things and what to go into and what not to go into. This is the first time I learned at 44 that you have to know who is in the business that you're in and their wherewithal to hold on when the economy goes down, because that will directly affect you.
That's really smart. Who are your competitive investors, I guess.
Yeah.
And that's a really interesting point about some derivative plays for taking advantage of some of this growth. What are your thoughts on the athleisure apparel type companies, Nike, Lulu, Under Armour? Aloe,
I mean,
pants now.
What
are the opportunities there?
I mean, we saw even before COVID, to see what Lululemon became for men was shocking to me, right? I thought that was that was really the growth of their stock for a while, was that there was a men's business. Under Armour, I think, is completely lost. Just too much employee turnover, and just seem like they're lost. I think
as like a bad business.
They just
internally.
And they don't have any defining characteristics. What do they stand for? Yeah, they stand for moisture wicking when they came out in 1996, but they don't have any. They don't have any brands or trademarks or anything that's too exciting, which is like not what any brand would want. I think, you see Aloe and these guys taking massive retail space. And obviously there's a lot of belief in the market. And I mean, I think there is true innovation. I've kind of watched the Brady brand. Don't think it's doing as well because, again, you need to do something different. You can't just brand clothing. That is so early 2000s. You have to have something different. And what Under Armour did prove is that niches can be hundreds, millions of dollar business, billion-dollar businesses, but you have to have your take. And if you're just branding clothing or shoes, it's not going to work.
So you think the others have more of an identity,
Yes,
and maybe
for
Blank
sure.
hasn't figured that out at Under Armour. Okay. What about private equity? You've made a ton of investments in the food and beverage area. We touched on that a little bit. Why do you think that is such an attractive space, and what kind of opportunities could there be for our audience to get into?
So I run a mini food and bev VC called Tastemaker Capital. And our idea was just, hey, there's all these funds that are investing $25 million into companies. There's friends and family, which is just people putting in $20,000 to $40,000. There's not people who are putting $1 to $3 million into something for a company that has $1 million, $2 million, $3 million in revenue, might be worth $10 to $20 million. So to get in without fund money in kind of like an SPV structure with added value people makes sense. And so we put money in Vienna roasted chickpeas and Athletic Brewing, which turned out to be unbelievable non-alcoholic beer and its rise. And I think it's going to sell for well north of $1 billion. But the reason it works is because big companies choose to fail because of their bureaucratic ways, right? Like big companies can't it's against all odds for big companies to innovate. And they know it. In fact, they purposely fail at something in a category so that then they can prove to their manager that they should buy the one that was from scratch and that an entrepreneur built. So the reason why these things are, I think they're exciting. And what's happening now, though, is there are more companies. It used to be, okay, get the company as big as you can. And no matter what, even if it's not profitable, let's have a brand that spends $200 million on marketing and grosses $120 million, right? Doesn't matter. As long as you just get that gross number up as high as possible. And then 2 years ago, that stopped, and they said, I'd rather you be profitable by $1. And that kind of and things changed. And also there are companies now that are just too big, like Terramana Tequila, like with The Rock, like on its way to a $1 billion brand. Like someone's going to take a stab at that at 3 billion, at 4 billion. It's much easier to see how an alcohol company would take 6 stabs of $100 million companies than take the proven one at 3x of a number that's so big that odds are that there's no way it could ever get bigger than that. So that's really been the interesting thing for me, just understanding why investments like this work in good companies that are small. It's because the system is just set up for the big guys to fail and then buy. It happens over and over again. And then the idea that these smaller companies now, if they can get profitable, show proof of concept, that they could then be acquired at a different type of stage that they weren't going to be acquired before. So as an investor, that makes you think maybe you can get your money out. And it used to be, from a company that starts from scratch, 5 to 7 years. Now it legit could be 2 to 4 if you have a great company, because buying companies at 60 to 150 million for these big guys is really comfortable.
Yeah. That's kind of the sweet spot, it sounds like. Is there an analogy there for crypto? Like the big one that's too big fails potentially? Is there like an FTX analogy there? Or do you think what happened in the crypto space is just a sign of more to come? I know you and I have been pretty same on our on our bearishness and skepticism there.
Yeah, I just think if there's a lesson from crypto, or as of now, it's just, to me, it never really made sense from the, okay, so blockchain, get it. I get it. Perfect. Give me the chain of custody, give me everything. Fine. But then to make the leap to like, okay, well, Bitcoin is something that you're not really using, but it is the first. Well, there have been plenty of firsts that have not been the forever. So that didn't answer Bitcoin for me. And I just thought the utility was pretended to be something that it was not. And I also thought, I always think when you're investing in something, the key to investing in something, I think, for me, my success has been based on something that I do. It's something that I love. What were crypto investors in love with? Did they convince themselves that they were in love with the concept of crypto, or were they really in love with, once you get in love with just the money, you're in trouble. That's when you're really in trouble. That happened in sports cards too. People bought things that they wouldn't have bought if it wasn't for, I can make a buck here. Because then when you don't make a buck and you're holding the bag, it's not fun. If you have a piece that you love, that you know, even if the market goes down, that you'll hold on to, and it won't make you sick to look at it, that's love and enjoyment has a lot to do with it. When it comes down to just money and thinking about just how you can make money off it, it often doesn't work out.
You don't think these crypto bros were in love with
decentralization?
Decentralization?
I couldn't tell because I had to exclude some of my friends from dinner because, you know, it turned out to be, it was like an Herbalife situation. You know, it's like, it's like your aunt who does a multi-level marketing scheme and you can't stop talking about it, you know? So it's like, that was all they could talk about. Now, probably that way with sports memorabilia, but yeah, no.
Yeah, you are. And
I don't know if
tickets
it's
too.
and tickets. I don't know. I don't know if it's going to come back. I don't really have any guidance there.
Well, there's this popular idea, right, on Wall Street that when a company buys naming rights to a stadium, it's time to sell the stock.
That's been going on for 25 years, right?
But right. FTX, right, paid, I don't remember what you do, I'm sure, for Miami.
125 million, yeah, for Miami Arena, yeah.
So, and the SoFi paid
right.
what, 600 million for naming
so
LA's football stadium?
It is loosely tied to the concept of that these naming rights deals are very expensive and often there's not the ROI. And so that is an indicator of companies that are not spending their money wisely. So that actually makes sense. It's not just like, oh, there's this like spurious correlation, you know, between the someone who gets naming rights and the company. It actually does make sense that perhaps these deals are not that good, and this is their biggest not that good deal. So
it's like their Hail Mary.
Yeah.
So when companies spend this crazy amount of money on naming rights, do you think it's a sign to sell?
It depends on how well they do inside the stadium, right? Like, how did SoFi convert actual people? I mean, they sponsored the stadium. The Rams, the home team, was in the Super Bowl and won the Super Bowl. Like, you can't get any better than that.
But then their stock dropped 70%.
Right. So then that was the biggest chance you were ever going to get, and you lost. So, but it just depends on what the company does inside to make you. I'm trying to think of any, you know, when I go to Minute Maid Park in Houston, do I want to drink a Minute Maid? I do like the Minute Maid soda. No,
the lemonade is pretty good.
Yeah.
Petco, yeah. I do. It makes me feel good about dog stuff. Anyway.
But do you buy it at Petco? No. Yes.
You know, I can get down with that idea.
Okay.
It makes me feel good. I'm a new dog owner, and so I'm obsessed with that. So
I'm still not convinced your dog is real. I think it's a prop that you control with a remote control.
She's the best. But case in point, it's well taken that it's hard to convert that customer by spending so much money on the naming rights.
Yes.
All right. It's a new year, Darren. Happy New Year. Super Bowl weeks away. I cannot believe that's already a thing. Let's make some predictions, shall we? Who's going to win?
I think the San Francisco 49ers are going to win. They are, the fact that you had Trey Lance, their starter, go down, then Jimmy Garoppolo, who was their starter, who was replaced, go down. And then you have Brock Purdy, a rookie, and their defense is number one, so good. When Lance went down, I was like, this is an opportunity to bet. So I have a ticket, $5,900 to win $107,000 for the San Francisco 49ers to win the title. And I believe they will.
And where is that ticket?
DraftKings. And I did shop, unlike other people we talked about. I do have like 17 different apps. I did shop, and I got the best 16-1 odds on.
That's why I wanted to
October
ask.
when that went down.
What about the NBA championship? Should we just keep going? Like, can we get your predictions on all the things? Stanley Cup, World Series?
It's too early. I'd love to get my Devils bet. And they did win 14 in a row, but my Devils,
yours,
my Devils,
only
I'm a
yours.
season ticket holder, so I can say my Devils. I have a bet for that. That's 1,800 to win 117,000 if they win the Stanley Cup.
Damn.
I know, long odds. But yeah, and I'll tell you what my New Year's resolution is. My New Year's resolution is really like legitimately living one day at a time, because I was getting so anxious. I'm being so honest here. I do a mental health podcast. I was getting so anxious from thinking about far into the future and this year. And so I'd encourage people, like, when you're thinking about your resolutions, like, yes, I get it. It's a goal. It's a time where we reset, but like, don't get too far ahead. Because I started thinking too far ahead and I was legitimately having anxiety over it. And so I changed it up to say, just do the day by day. And, here we are, and we're 5 days in, and I'm loving it.
Well, I'm loving talking to you. Can I ask, I don't want to give you anxiety. So if it doesn't give you anxiety, what about like a nearer term prediction about Tom Brady?
Man, after FTX, after Giselle, I mean, he has that $300 million broadcasting contract waiting for him. I feel like he is never going to have a perfect ending now, right? He's got a game coming up that he might have his first losing season ever, excluding 2008 when he was hurt. I mean, it's been a rough year for him. And I feel like he is one of those guys who wants to tie the bow on his career. And unless he's going to another team under his own terms and arranging the team like LeBron, I just don't see that happy bow being tied. And maybe he goes off into the sunset and is on your TV for 10 years for $30 million a year. Not bad.
Doesn't suck.
No.
It doesn't suck. Yeah, well, if he's that concerned with perfectionism and tying it up in a bow, I think he should go on your mental health podcast. Maybe you guys can work that out.
Absolutely. I'll send that to him. I'll send this clip to him.
That will do it. I'll turn it over the edge. Well, you're very good for my mental health. As always, D-Row. Thanks.
Thank you.
Darren talked about sports having a unique value proposition. It's the one thing that people watch live, and that is why it has a premium valuation. And of course, we can use Magnifi, which is like Google for investments, to get some suggestions. Take a look at this. It's very simple. I just type, I want to invest in live action sports in the search bar. Here's what I get. I can sort by fees. I can sort by risk. I choose now to sort by returns. So when I type that into Magnifi, I get a stock, GOLF. I get a mutual fund and a couple of ETFs. Darren also talked about food and beverage at sporting events. He talked about how energy drinks specifically have a greater return in the food and beverage industry. I can search drinks for wellness in Magnifi, and the AI understands what I'm looking for and gives me these results. Again, I can search by return, and that's what we're going to do here. And I get Celsius Holdings as a stock option that I can look at if that is what I'm interested in investing in. Really, really great information today on the sports business industry, on the future of online gambling, and even some Brady predictions. Most of all, a great way for you to make better informed investment decisions. If you want more information on investing with intelligence in a volatile market, please visit us at magnifi.com. Take good care.